Hey, good morning, everyone. Good morning. Welcome to the CoinSash Theater. My name is Ting. I'm the co-founder and CEO of CoinSash. What an exciting time is now to be in crypto right now. We're nearly at 100K, and I think this time last year, we're not even at half the price. So very exciting indeed. Can I get a show of hands? I think there's two things that drives crypto adoption: technology and money. Can I get a show of hands? Who's here for the technology? Some of us, okay. Who's here for the money? Yeah, I think we all are. I almost think it's a bit inappropriate to talk about technology right now in this current market. So today I'm going to talk a bit about money, and most importantly, how to make money in this current market. So every day we're here, we always have that friend or a few friends who's made millions of dollars overnight. They either a Bitcoin maxi, or they invested in some early stage projects, or they just simply start their own business. But a lot of these things, it takes a lot of courage. It takes a giant leap of faith, and a lot of the time they're putting their capital and time at risk, or a bit of both. What I'm going to talk about today is how to make money in a nearly risk-free manner, which is what I call arbitrage opportunities in crypto. Just to bring some relevance to this, the way me and my co-founder started CoinSash all the way back in 2017, we grew it from nothing to now have 40,000 users, traded nearly $1 billion, as well as being around for 7 years, is we were able to capture some of the early arbitrage opportunities in crypto. So today I'm going to spend a bit of time about our past experiences and how repeatable that is in the future. And hopefully I can give some indications as to what are some of the future trends I believe to be. So without further ado, let's dive into it. So the concept of arbitrage is not a new one, right? So it's a very commonly known concept in traditional markets. The Investopedia definition is it's a simultaneous purchase and sale of similar assets for tiny price differences in order to profit. I think when it comes to crypto, I actually slightly disagree with this definition. I think for crypto, we don't have to have similar assets. There can be assets that are somewhat similar in nature, but not exactly similar. Also, most importantly, I think in crypto, the price differences can be quite big, which I'll give a few examples later on. And that's good news for us. We also know arbitrage opportunities thrive in inefficient markets, which means crypto in its infancy is the best example for that. And as the market matures, there's going to be more sophisticated tools and opportunities, which I'll allude to in a moment. So before I start, there's a few things that I want to point out that I don't consider as arbitrage. So I'll just go through this quickly. So number one is there may be a lack of free economy. So you may think, oh, if I buy here and sell here, there seems to be a good profit, so I'll just do it. But an example I give is, I think it's back in 2018, there was a very reputable exchange. And due to some reasons, I think there's an issue with their cold storage, that people cannot withdraw Bitcoin from their exchange wallet. So by definition, the price of Bitcoin on the exchange was lower. It's lower because you can't withdraw it from the platform. So what I'm talking about here is not a temporary limitation on withdrawals. These people were placing their faith in the withdrawal being reopened to the public. So these are some of the pitfalls that we need to look out for. The second thing is the arbitrage opportunity. Are you really capturing arbitrage opportunity, or are you providing a service? So what I see a lot these days is people are actually providing broker-like services. So you're providing your bank account, you're providing your time and effort, trying to find clients and sell them crypto at retail rates, while you're buying crypto at wholesale rates. And this actually takes a lot of time, effort, dedication, as well as some of the banking rails in order to do so. The last thing I want to point out is, which is very important, is inventory risk. We may remember back in 2021, when the NFT market was very vibrant, there were people who are flipping Bored Ape yacht clubs, as well as CryptoPunks. I remember there's quite a few OTC players who are buying CryptoPunks for 20 ETH, selling it for 25, but then guess what happens when the market crashes? All of the inventory is going down with the market crash. So there's actually a lot of inventory risk that goes with it. To me, if there's true arbitrage, they would have borrowed the CryptoPunks or the other NFTs that they are selling, buying and selling, and just have it on the loan as their inventory. That would eliminate some of the risk. So there's about 4 examples I want to give, and some of it is directly related to what my experience has been in the past. Number 1 is, I write here China's mining power. So I'm not sure if everyone's aware of this. Back in 2017, I remember very clearly because obviously I'm originally from China. Back in 2017, China has about 85% of the world's Bitcoin hash rate. So for those of you who are new to mining, it basically means China has about 85% of the world's computing power. And there's a good reason for that. I think in the Sichuan province, if I'm not mistaken, there's a lot of cheaper hydraulic electricity. So a lot of the miners, they naturally flock to cheap electricity sources. So that's what happened in China. So what we were able to do is we were kind of buying Bitcoin, so kind of importing Bitcoin from China, taking it to Australia, and then sending money back to China again. And I remember very clearly at the time, the price differences can be as high as 10%. And it wasn't, in my view, it wasn't that hard to do. So all you have to do is have a Chinese bank account, Australian bank account, and someone you know that sells you Bitcoin. So we actually accumulated a lot of our early success from the Bitcoin price disparity between China and Australian prices. The second one I have there is probably a bit more well-known. It's called the kimchi premium. So I guess we probably all know what kimchi is. For those of you who don't, it's a very popular Korean pickled cabbage dish. So this term was used to describe the premium that people were paying on South Korean exchanges at the time. I think it started back when it's 2016, finished around 2018. And the difference is, the range was between about 4.8% above market rate, and to one stage, I think it was January 2018, to about 55%. So that's huge, right? So you may ask, okay, so how freely can I withdraw money in and out of Korea? So there's some limitations, but taking money in and out of Korea, if you had the right connections, it wasn't entirely impossible. So the caveat to that is you needed to have the right connections to be able to take money in and out of the country at the time, which is a challenge in itself. Now you may think, oh, all of the examples you've given is kind of between Australia and Asian countries. I don't really have all the connections, so it didn't really apply to me. So the third one I'm going to go to is there's actually some Australian and US disparity. And this, I remember very clearly, this was back in about 2018, 2019. At one time, there's about 10% price difference. I still can't pinpoint the exact reason as to why that happened, but all I know is it did happen in the past, and to date, we're still seeing, depending on which market you look at, we're still seeing a very small price disparity, even in some of the major coins between Australia and the United States. So that might be something that's worth looking at. Last one I want to highlight is what I call exchange P2P disparity. So for those of you who are not familiar with the term, P2P basically means peer-to-peer. So for, I guess, peer-to-peer trading was very popular back in the days, especially when, I guess, before 2020. But a lot of the activities these days are happening on exchanges. So what I've observed in the past is exchanges typically had one price, and peer-to-peer had a different price. And there's a number of reasons for that, which I wouldn't go into too much detail. But long story short, some people preferred exchanges, some people preferred peer-to-peer trading. And depending on the liquidity pool at the time, there's very different arbitrage opportunities that were available even in the same currency. So that's the importance of here. So compared to the previous 3 examples I've given, here you can actually make some arbitrage opportunities even in the same currency. Okay. So fast forward to today. So we're now in 2024. We've been through quite a few cycles of crypto bull market and bear market already. So you may ask, what are some of the opportunities that we're seeing right now, currently? In brief, there's probably 3 big ones that we're seeing. And I want to highlight that a lot of this is very well known. I guess the knowledge is the public domain, but the execution of these theories is very difficult in practice. So I don't pretend to be expert in all of this in terms of how to actually carry this out. But we do know if you're interested in the opportunities right now, these are worth looking into. So the first one is Grayscale BTC. This opportunity probably closed around January this year, but I think just for the sake of currency, I still include it here, given how big the opportunity was back then. So for those of you who remember, Grayscale Bitcoin Grayscale Bitcoin, which is a fund, it first the first inception of that was back in 2013. So that was actually a long way back. And it started as a closed-ended fund. So that word is very important. A closed-ended fund versus an open-ended fund. The key distinction is in, obviously, the words closed-ended. So by being closed-ended, it's very difficult for people to, I guess, either top up or redeem from the fund. So what happens in a bull market? In a bull market, people would want to buy the shares on the secondary market, which drives the price up. But in a bear market, which we've seen the 2020, about 2022, and all the way throughout 2023, GBTC was trading at a massive discount, a quite significant discount. I think at one stage up to like 55% compared to what I call the NAV, the net asset value of the actually underlying Bitcoin. So some of the smart fund managers that I know, what they do, they buy GBTC on spot, and they sell Bitcoin at spot, right? So it doesn't even need any futures, perpetuals, not really so much collaterals needed. They were basically able to ride that wave. And guess what happened? In January 2024, this year, the gap closed to zero when GBTC turned into an open-ended fund, which is an ETF. And that arbitrage opportunity, I experienced firsthand. I kind of dabbled into that myself, and then paid off like in two ways. One is I was able to capture the price differences between GBTC and the underlying Bitcoin, which is 55% at the time. And Bitcoin price also gone up by, I don't know, two and a half times. So if you do the math, with $100,000 in capital, you can ride it all the way up to $500,000. So that was a very significant opportunity back then. Second one is, and this is what people still are doing, right? So we all know, I guess we all know Michael Saylor. We all know MicroStrategy. That's on the front page, left, right, and center. So what's the relevance of MSTR and a few other mining stocks? What's the relevance of that to this? The relevance is, what I'm saying, the same smart fund managers, they are obviously the GBTC opportunity closed in January this year. So what they are doing right now is they're looking at trading with Bitcoin and Bitcoin-related stocks. So when I say Bitcoin-related, it doesn't even have to be like MSTR. It might be like an RS Energy or like another Bitcoin mining stock where they perceive there to be a correlation. Let's just say the correlation is 2 to 1, because people used to say, oh, MicroStrategy, if you buy MSTR MicroStrategy, that's basically buying Bitcoin on leverage, 2 to 1, right? So if that's your perception and you've done your calculations around that, and if you see a price difference that deviates from that 2 to 1 ratio, guess what you can do? You can buy one asset and you can take a short position in the other asset. And that's what I'm seeing the fund managers are doing right now. In terms of the exact ratio and how they do it, I don't know the details, but it's something that's worth looking into if you're serious about it. The third one I want to talk about, and this is quite widely explored already, is basis trading. So for those of us who are not familiar with the term basis trading, it basically means a very easy example is if you want to capture the differences between the spot market and the futures market. So currently Bitcoin might be trading, I don't know, are we 100K yet? Probably not, 99, right? Let's just say if Bitcoin spot is 99,000 and the futures is 101. So if you buy Bitcoin at spot and you sell Bitcoin futures at, let's just say 6-month futures at 101,000, as 6 months passes, the price differences will naturally converge to zero. So you'll be at, I don't know, say at the time Bitcoin is 100K. I hope we're a bit higher than that, but let's say it's 100K. So we'll converge to $100,000 and you will be able to capture the difference. So you might ask me, oh, if it's so easy, why isn't everyone else doing it, right? If it's so easy, if it's just simply, you got to place an order here, and capture the difference. There's two things you got to watch out for when you deploy this strategy. One is there's always a cost of capital. So by doing this strategy, you have to long Bitcoin and short the futures. Sorry, I got it the wrong way around in my example. So you got to sell Bitcoin at spot and long the futures. Sorry. No. No, sorry, let me, third try. No, you got to sell the futures and long the Bitcoin spot. Okay, so guess what you got to do? You got to have the money to buy the Bitcoin spot, right? Let's just say it's 99,000, and then you got to put up, let's just say, depending on the exchange, it might be a 20% margin to short the futures. Okay, so all of a sudden you are out of the pocket by 120,000. So your cost of capital for 6 months on that 120,000 might outweigh your return, right? So that's why these days we typically only see the professionals who know exactly what their cost of capital is, who know exactly what their transaction fees are, and who know exactly what their funding rates are. And those are the three major costs that goes into basis trading. I can go into like this a long time, but I think for the purpose of this presentation, you guys get get the hang of it. Apart from futures trading, there's also options. So we're talking about the derivatives market. There's options, and there's also what I call perpetuals, which is quite unique to the cryptocurrency environment. Okay. So looking forward, I think this is what we're excited about, because we all know what's happened in the past. The past is the past. We can't change it. We say history is a reflection of the past, but it's a teacher for the future, right? So that's what I want to be focused on. Before I go into some of the ideas I have, and just to be frank, this is not financial, obviously not financial advice, but before we go into the ideas I have, I just want to observe a few trends. So we're going from simple to sophisticated, and that is just the nature of any market as it matures. So if you remember the first example I gave, all I had to do is buy Bitcoin in China. I can't even take a day to get it to Australia and then sell it here. How easy was that? That's very simple. But these days, if you think about the example I gave in basis trading, you've got to be very on top of your charts, on top of your cost, on top of your how you get your capital. So becoming increasingly sophisticated. We're going from manual to automated. I don't think I need to explain that too much. From relationship-driven to product-driven. So back then, if you had all the connections into United States, South Korea, China, it's very much a relationship-driven game. It's about who you know. Do you have a reliable broker that you can give your money to without having to worry about getting scammed, right? So back in the days, that's all about that. And I think one thing that cryptocurrency, the industry has improved on is there's a lot more trust in the space now. There's a lot more, I guess, established brands and products. So it's no longer, in my view, it's no longer a relationship-driven game, but it's more a product-driven game. So have you built, or have you considered building at least, say, a simple arbitrage bot? I know it's harder than it sounds, but for those of you who have an IT background, it's actually not that difficult. So relationship-driven to product-driven. I guess the only other thing I want to cover is probably going from slow to fast. So back in the days, you can take a day and still make 10%. These days, you probably, the opportunity probably is gone in within milliseconds, right? So slow to fast, that's what we see not just in cryptocurrency, but in any financial markets. As the market matures, I think we're going out of our infancy now, especially as we're crossing the 100K mark, we're going into like, say, internet in the 90s, like we're going into the adolescent phase. We're going from very slow to reasonably fast. And single dimensional to multi-dimensional. Okay, so this is important. I think it leads to my next slide. So historically, you are able to just think in simple terms, right? So Bitcoin, buy Bitcoin here, sell Bitcoin here. Buy Ethereum, sell Ethereum. Buy CryptoPunk, sell CryptoPunk, right? So the dimensions is very simple. Going forward, you may have a few different, I guess, related assets you want to look at. So you may want to look at, for example, the example I just gave was you look at all the Bitcoin-related stocks and you look at Bitcoin. Or you may look at anything that's related to NFTs, but then you have your actual NFTs on the side, right? So from from one-to-one to one-to-many. So those are the trends I've observed in my personal experiences. Okay, so these are some of the ideas I put on the table. Once again, I say this is not a financial advice, and it hasn't, I think some of it may have been tested, some of it haven't been, right? So I think we spoke about basis trading before, and I've read a paper, and it's a very interesting paper. So they say Bitcoin basis trading is actually quite well explored. So remember the KVS I gave a bit earlier about you gotta be really sharp with your pricing. And that's the case with Bitcoin. You're competing with the sharks. You're competing with the professional, institutional arbitragers, right? But the same is not the case with other cryptocurrency assets. Like Ethereum, I'm giving Ethereum an example, but what about Solana, which is very hot recently? The studies from that papers, and this is very recent, this is like October 2024 recent, they're seeing a bigger price differences in Ethereum basis trading compared to Bitcoin. And to me, it just brings me back to the point. When an asset is in its infancy, the opportunities are more abundant. So something worth thinking about. I think the second dot point is about the same. I mean, Bitcoin stocks are very well researched, MicroStrategy on the front and center of every single, even traditional newspaper these days. But if there's another stock that's related to other assets like Ethereum or other cryptocurrency assets, I think that's worth exploring. You don't, like I said, you don't want to be swimming with the sharks. Something that's quite recent I want to point out is I think a lot of us have heard of Polymarket, especially given the most recent US presidential election. Poly market is a very, I guess, insightful tool to look at some of the odds that people are placing in real time, and that's on-chain. It's across a number of different chains. So without being, I guess, a big proponent for poly market, I think it's doing a lot in terms of price discovery for the industry. Having said that, a lot of the traditional bookies, like people like, I don't know, Ladbrokes, Sportsbet, they're still pricing their book using their internal algorithms and pricing their books in terms of their own risk appetite, right? So there might be a price differences, especially at these major events like US presidential election, that you're able to place a bet on the poly market, which is on-chain versus off-chain. So that's I think the on-chain and off-chain interaction is very important when we look at the next phase of arbitrage opportunities. Other creative ways, I wouldn't go into every single one of them, but crypto NFTs. So I mentioned NFTs earlier, but there's one example that I just can't get over. Just so exciting. I mean, I think I remember it was only a few months ago, someone acquired a fractional NFT. And the fractional NFT is, I think I remember it's in the form of a CryptoPunk. And it's a pretty rare one as well. So if we are familiar with CryptoPunks, there's like your normies, and you have your aliens. Sorry, aliens at the top, you have your normies, you have your zombies, you have your apes, and your aliens, right? So there's an ape CryptoPunk, I think that's worth millions of dollars. So this guy had about a shard, which is about 1/150th of a CryptoPunk. And they were able to initiate a transaction, basically selling it to himself at a lower price, and counting on no one else objects. And guess what? No one else objected. So to me, the arbitrage opportunity is you buy a fractional NFT, and you may have more say than you think, because most of the people who are also holding the fractional NFT, they're not really giving attention to it. Okay, so the last arbitrage opportunity I want to give is, have you thought about working for a well-backed startup? So I'm kind of beating my own drum here, but to me, if you work for a startup, your upside is very unlimited. But a lot of the startups, their downside is if the startup goes under, then you lose your jobs, right? But I think based on my experience at CoinStash, we are very well backed. I mean, myself, I'm putting all of my blood, sweat, and tears into the business. So, and we're hiring. So I guess that's the last arbitrage opportunity I want to point out. So if you work for a well-backed startup, you have all of the upside and very limited downside. That's it for me. Thanks very much.